Good afternoon, everyone. Today I'm chatting with Ole Hansen from Saxo Bank. In today's interview, we discuss commodities, which commodities we should be watching as mining investors, and also where we might see some more volatility, of which he actually gets into food prices and why we might want to be a little bit concerned. All right, everybody, enjoy the interview. Ola, thanks for joining us.
Thank you very much, Steve.
So I love when I get to chat with people like you because you've got a very unique perspective. I know you travel to the US quite a bit. You work in commodities, so I'm sure you're talking to lots of Canadians and you're based in Europe. And I look around at what's happening in the world right now and sort of culturally what's kind of gotten us here and the political leaders who all have their own agendas. But I gotta ask, for you, somebody who travels quite a bit and talks to people, in Europe, what's the sentiment like right now? Is there a real sort of, uh, we'll say, depressed state over the tariffs that might be coming? Are people rolling their eyes at it? What's your view on it?
Well, I think first and foremost, bringing back a quote from, I believe it was Lenin saying that there are decades where nothing happens, and then sometimes decades happens in weeks. And it really, boy, it feels like that's what we've been facing now in the last months or so. So I think the sentiment is one of really one of shell shock, because with the initiatives and the statements that we're seeing coming out of Washington, we're basically seeing a breakdown in how the world has been looking at the U.S. and how the U.S. has been looking at the world since the Second World War, when U.S. finally got involved after the attack from the Japanese at Pearl Harbor. And since then, it's been the world has really been looking to the U.S. for, I would say, for protection, and that if we should take what's been said recently at face value, that is no longer the case. I think probably some of it is okay because it is wake up call to the rest of the world, especially in Europe where I'm sitting. We have become bogged down in regulations for years. We have an unelected EU Commission that potentially is not operating at the best interest, but that's one thing. But another thing is simply the speed with which we've seen some of the changes and how to respond to it, and that's really where we are caught right now. And I suppose the same goes for Canada. I mean, it's from us to looking at Canada and US. Obviously, we see them as two major trading partners and basically alike, but there are definitely some cultural differences that seems to be coming through here. And I think we talked about it before, that when someone tries to bully you, if you are not in the situation where you are used to that, then you kind of become a bit dumbfounded and struggling to come up with a response. But I'm sure in good time, both Canada and Europe will come up with a response, and some of it. Over time, hopefully something good will come out of this. But right now, it's, as I said, the decades has almost happened in a week here.
For you as a commodity strategist, when you think about these tariffs and you think about the impact that they could have, my high level overview of it, and it kind of breaks my brain just thinking about the mechanics of what might be about to happen with Trump's basically trying to isolate the US from the rest of the world, other than maybe Russia, who he seems to be friendly with all of a sudden. Um, I think about GDP is probably going to drop. And then I think about how governments are going to respond. They're probably going to print a bunch of money to try to prop up jobs in the economy. Because let's face it, the entire economic structure in the Western world is built on debt, and we can't have a deflationary cycle, or else the entire economy collapses. So it sounds like that's probably going to be the likely scenario. But then there's this whole aspect of what's going to happen with commodities, and is the U.S. going to want as much copper if for some reason their government imposes 25% tariffs on copper? And then there are copper deposits that are undeveloped in the U.S., but they more than likely would end up costing more than 25% because they're so low grade that it's just not going to be that economic to mine them unless you start charging a lot more for copper. So anyways, to give you that preamble, what's your view on it? Where do you think commodities are heading?
Well, I think first and foremost, Trump's policies is most certainly inward looking. He wants to make America great again. He wants to roll back the globalization that we've seen for the past 20 years, where production has been moved somewhere else to cheaper production locations. And he basically wants to roll back 20 years of developments in a matter of, well, basically within his presidency. So in a matter of a few years. And that obviously is causing a lot of conflicts and pain. And the tariff war is another way of just trying to force production back to the U.S. If you want to sell to us, you have to produce it here, and that's having quite a profound impact. But generally, if you look at the commodity space, we've had a phenomenal start to the year, and it's an interesting start considering that the market was obviously somewhat worried about the tariffs coming and what kind of impact it will have on the global outlook for growth, and with that also demand. But it's also painting a picture of several drivers that longer term will continue to underpin commodities, not specific ones, but also not on an individual, but also on a sector basis. I've written some of them down because I've been writing about them in recent update. There's no doubt that the deglobalization is going to force up prices in some locations. It's going to basically increase cost of some of these mined metals and also end products. We got the whole defense area where especially in Europe, we've seen how there's been a divergence between defense stocks in Europe and the US in the last couple of weeks, because the Doge department is looking for savings that may lead to fewer contracts to US weapon industry. But at the same time in Europe, we have to gear up quite dramatically. So we're seeing defense stocks on the move. That is obviously commodity intensive. Lots of different minerals especially will be needed for that. We have the decarbonization. You talked about US, whether they're going to scale back or not. Don't think it really matter in the long run, because ultimately it's what people want that drives it. And what the US most certainly want is superiority on the technology front, and with that AI. And that means data centers, which will require a heck of a lot of power to be run in the coming years. We have climate change, which is lifting demand for heating or towards cooling across the world. And then elsewhere, we have the continued rollout of EVs, which is very strong in China right now, also in parts of Europe. That trend will continue, and that overall will lead to increased demand for power in the coming years. And that power can only be supplied to consumers if the infrastructure is in place. And that's why infrastructure companies that build and supply these constructions, they have been doing extremely well in the past few years. Just take Europe, some like Siemens Energy in Germany is up more than 200%, simply because demand for infrastructure projects is off the scale, and that will continue in the coming years. So the decarbonization will be part of it. We have the de-dollarization. That's more of an investment perspective for gold. Central banks and high net worth investors worry about the financial debt situation in the US. They're rushing into gold. That will likely continue. And then the debt overall is risk or the core, and the risk that it may cause financial instability is also a haven question. Then finally, we have the demographics. We are an aging population in many parts of the world. That basically means we have a fewer younger people that needs to produce what a growing aging population demands. And we also have a growing aging population which is quite wealthy. I'm approaching that age, and obviously we're a generation which have been blessed with rising stock markets, rising property prices, and that means there's a lot of money to be spent, and that will also be having impact on the general level of consumption of commodities. So long answer here, but we are generally up, and the Bloomberg Commodity Index, which I track, is up today around 10% on the year. It rose 5.5% last year, so we're already up by twice as much as the S&P, and also twice as much as the MSCI World. And it is all sectors that are kicking in there. We're seeing soft commodities, we're seeing agriculturals in the grains, we're seeing precious metals, and we're also seeing energy prices moving higher. So I think that these trends, perhaps a little bit too strong here at the start of the year, but I think these trends will continue and will prevail in the coming months and years. So we are a firm believer in higher commodity prices.
I think about you being a commodity strategist and sort of what's happening in the world. And there's sort of this debate that's going on, I think, about people who are talking about those sort of macro commodities that, at least in the Canadian junior markets, we talk about quite a bit. For example, uranium. And I gotta say that it's very hard to understand where demand for uranium is gonna be in 5 years or 10 years, in the sense that we've got these large language models, LLMs, that, um, the original idea was they were gonna require all this power and all this infrastructure, and the stock market was kind of roaring on this idea that they need all these chips and all this power in order to operate. And then DeepSeek came along, and it was doing it at, like, 99% less power. And I'm curious, for you to be a commodity strategist, you almost have to be a technologist now because, these are huge variables to input into a model of how much, uh, power are we actually going to need, and how many chips are we going to need to 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 serve the world's future AI needs, just to have any sense of being able to model. So how do you think about that when you're trying to think about where you see commodities going in the long run when it comes to things like AI and technology?
Well, the AI technology, as you say, Steve, is incredibly difficult one to gauge right now, and with DeepSeek throwing a hand grenade into calculations, it's really difficult to see where this one is heading and where it's going to land. But I think overall, the demand for power and thereby also the demand for the production of power will continue to increase quite strongly in the coming years. Data centers is one thing. Another one, as I mentioned, is the need for cooling. It's the EV rollout, the battery technologies that will continue to gain ground, and then just also the whole decarbonization that we are in a situation where we need to reduce the fossil fuel emissions in the world, and you obviously first of all will look at coal, which remains dead cheap but also extremely polluting, and we need something to replace that, and that's where obviously nuclear power is one of the sources that needs to be available together with gas to offset the variable production that we have from sun and wind. It simply is not working on its own. So we need the base load, and that base load is really needs to come from I would say natural gas, less polluting than coal, and nuclear power. But I just put out a tweet earlier today because it's I think uranium has dumbfounded a lot of investors because there was if we just roll back the time 12 months, there was a massive craze for this particular market a year ago when prices surged above $100, and today or yesterday, I haven't seen the price today, we dropped to 65 something dollars a pound. We are down 35% over the last year. And I think what it most of all highlights is just the market that got ahead of itself. We have to remember when we're dealing with commodities, we're not dealing with a junior mining stocks or a stock in general where you take a bet today on future earnings that it's cheap today, but you think they will recover and make and start to earn money in the coming years. So that's why it's a good cheap bet for a long-term investment. You cannot do that when it comes to commodities simply because it is a spot product. It's a daily supply and demand. And if you're buying it, paying it up to a level that is not justified by the current supply and demand situation, then something is going to give, and that's what we are seeing here. Prices are simply too high. It's to justified by the current demand outlook. Not to say that demand will not increase in the coming years and thereby justify higher prices at some point, but it is just a reflection of commodities that when that is it's not good for speculative bubbles because they will deflate fairly quickly because ultimately if demand does not stack up then the price will revert low, and we've seen that on several occasions. So we've seen it in crude oil, we saw it in copper last year in around April time when copper prices spiked, where there's a bit of an AI craze going into copper because people thought a lot missed the rally in Nvidia. Then they looked for secondary markets that potentially could be impacted as well by the data center and AI craze. And suddenly investors started to attack copper. But again, that simply doesn't work because that is a long-term play, and supply at copper that time was actually very ample, and it still is. So it's an important part to understand when you're dealing with the actual underlying raw materials that supply and demand is ultimately what sets the price.
For our audience who we've seemingly picked up an audience that really likes junior mining or mining in general. We cover the big caps as well. And what ultimately is going to make a lot of these stocks work is being able to predict where you're going to be able to catch alpha in the actual commodity, right? Like If silver's trading at $34, most of these silver juniors, they don't work. When silver's trading at 18.20, they told us they would work at 30, and then we got there, and guess what? They still didn't work. I assume that for silver production to really kind of ramp up, we're probably going to actually need $50 plus silver for there to actually be tangible cash flows hopping in. I mean, there's some we see some, and we were chatting with Rudy Frank from Seabridge the other day. They just did $100 million bought deal. So there's definitely some capital flowing into the mining names. But at the end of the day, if you're investing in a lot of these names that are pre-production, you got to get the macro right. So where I'm going with this is when you think about the commodities and if you were deploying capital into the equity names, where do you think we're going to get those macro tailwinds that will make a lot of these deals make more sense?
Well, simply as you said, that we need to see higher and higher for longer and stable and higher prices,
Yep.
making these investment sound that really is the challenge because from a trading perspective, we're trying to gauge where price will go in the next week or next month or next quarter. But mining companies, they have to look 5 or sometimes 10 years ahead to try to work out what the price would be at that time. And obviously, there's no doubt that inflation has been eating into some of these new projects in recent years. Labor is a lot higher. Energy costs has moved up. The cost of materials as well. So the bar for the profitability barrier has been raised, and that basically means that you really have to be quite a firm believer in future strength in prices, and that's obviously difficult to a certain extent when you are dealing with prices already in silver at 12, 13-year high, a record high price in gold, whether they can continue. But I think even if we can maintain these price levels, then the profitability will also be there, and it will be notable in the coming months and quarters. There's most certainly a rising gap between the total cost of production and current spot prices. I think the main thing is that we get a little bit more stability into prices. You mentioned silver, and it is obviously gold on steroids, and that's why we're seeing quite often that when gold rallies, silver rallies harder, but the same thing happens what's in reverse. Part of that reverse is also the simple fact that gold, it seems like every time it's dipping, it's being bought by central banks. Gold hasn't got that luxury it hasn't got some big guy sitting there underneath with a clunking fist and just taking in whatever is available. So that's why we're seeing this higher volatility in silver, and that for some is potentially can be a little bit difficult to manage.
So, are there any commodities though that you particularly are most bullish on when you sort of think about like, okay, I've only got one choice to make here, and I'm looking for where I find the most attractive risk to reward on putting my chips on one commodity. What would that be?
Well, I would like to say that I would like to buy an ETF basically covering the whole sector. But that would probably be too easy, and because I'll be very happy with that 10% gain year to date, and also simply because I believe that the longer term view is for higher prices. Also, simply with one thing we haven't talked about is inflation, because all these tariff, if they are being rolled out, they will be inflationary. We are in a world where investors will be looking towards tangible assets. If I have my first pick would be a broad exposure to commodities, but if I have to dig a little bit deeper and single out the individuals, then I think I basically still believe that the natural gas in the U.S. is dirt cheap relatively to the rest of the world. It will be we will see increased demand not only domestically but also from exports in the coming years, and that will help underpin prices. And then, as we have already talked about, the demand for investment metals, I think is unrivaled. We haven't seen the strength of this kind of demand in a number of years. And if gold goes up, I believe silver will do even better. We are looking at the gold silver ratio right now just sitting below 90. It looks like we're finding some resistance around 91. So every time gold outperforms silver and it moves above 90, there seems to be a bit coming back into silver. So if we can make it to 30 to 3,000 in gold, I wouldn't be surprised. Over time, we could also see silver make it to 40. So silver and natural gas, and then one I don't like to talk about, but I think we can't avoid it. Is the food situation. We've had some 2 or 3 years with ample supplies of some of the key crops: corn, sugar, the corn, soybeans, and wheat. We're already now seeing some of these stock levels starting to come down, and again, leaving us much more exposed if we are to run into to a bad production year. So I think the agricultural sector is one we need to keep an eye on as well. Just like we've seen individual markets like coffee and cocoa really take off in the last year for various weather-related reasons.
We just did a video on coffee prices. You think that there's any way that coffee prices are going to come down, or do you think that we're kind of at a point where just the way that climate have changed over the years that we're going to have to get used to higher priced coffee?
Well, someone put a graph up there recently that if you look at the inflation, if you look at coffee price today, which are at a record highs, and compared to when the last time it hit a record high in 1973, coffee should actually be trading around $15 if it's inflation, or 15 cents if it's inflation adjusted. And I'm just looking down on my screen that we are currently trading just above $4. So with that in mind, it's actually still relatively cheap. We have just become very accustomed to relatively low prices for coffee. The problem with coffee, the problem with cocoa and some of the other soft commodities is simply the fact that they're produced in relatively small areas, making them a lot more weather exposed to changes in these particular areas. We saw that last year with cocoa, where it was Africa, Ivory Coast, and Ghana, where they had big problems, and that sent prices on skyrocketing. This year it's been twofold. Vietnam last year, followed by Brazil this year, which has really left prices or left supplies very tight. And these are not corn or soybeans or wheat, where you can just stick a seed in the ground in the spring, and you have a new crop at the end of the summer. These are trees, and if they have been damaged, it takes time to rectify. And I think with that in mind, we probably need to accept that prices for coffee will be higher in the coming years. And also, just we have to remember that the input, the us as a consumer, we are probably not as price sensitive to coffee. I will still have my 2 or 3 cups every day, whether almost no matter what the price is, and I think that goes. So it's not as price sensitive as other commodities, where we normally say that the best cure for a high price is a high price, because it incentivizes production while lowering demand. I think we don't have the same structure in something like coffee. So unfortunately, I think we have to get used to higher coffee prices, and perhaps even higher than what we're seeing them right now.
Okay, Ola, last question for you. If anybody in our audience is looking for some more of your commentary, where can they go to?
Well, I'm still on Twitter. As long as I stay away from the political side of things, it's actually still quite a useful venue to give and receive information. You can find me at Ole_S_Hansen, Hansen, and otherwise, obviously, I work for Saxo Bank here in Copenhagen. We're a global provider of liquidity to institutional and private investors, offering access to markets. And we have a website which is called analysis.saxo, where we post our output. So that's probably the two best places to go and find my production.
All right, well, Ola, thanks very much for hopping on here. We appreciate your time, and let's chat again in the coming year as we continue to see more volatility in commodity prices.
Thank you, Steve. Thanks for having me.
All right, everybody. Thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Also, let us know what you think in the comment section. Thanks, everyone.